Hi, I'm Patrick Palm, CEO and founder of Favro, and this is the Learn from Leaders podcast. The background to this show is that Favro customers are some of the most innovative companies in the world. Enterprises wanting to be more agile, software as a service companies scaling fast, and game developers and publishers wanting to master live ops. So we get to know some truly inspiring leaders in product development, marketing, operations, sales, executive management. And what we do here is that we interview them about leadership so we can all learn from them. Let's go.
Hi, and welcome to the podcast. This is the first of 2023, and I got Viktor with me. Hey, how's it going?
Hi, man. Going great. How are you doing?
I'm good. A bit jet lagged though. I just got back to Sweden from the other side of the world. But I'm really looking forward to this conversation because, I know we can speak Swedish to each other, but the audience is not mainly Swedish speaking, so we're going to keep this in English. But obviously 2022 was quite a turbulent year, and everyone seems to be expecting that 2023 is going to be quite a turbulent year as well. And there's a lot of companies going under, companies seeking investments. There's still going to be a lot of exciting new startups coming up that needs angel investment. And you are one of the most interesting angel investors I know.
Thank you.
So I'm super happy to have you on the podcast.
Does that mean that you don't know that many angel investors, or am I?
I know quite a few, to be honest. I would say that my statement is quite fairly grounded. Anyways, before we get into talking about the economy right now and the investor climate and your perspective as an angel investor, I think it's important that we introduce you to the people who don't know you, like your background. Basically, what's your story?
So I have a few versions of it, but I'll do the short one here. As I said, my name is Viktor. I'm from the West Coast in Sweden. I grew up in Gothenburg, went to Chalmers University of Technology, where I spent 3 years learning to code, basically, before dropping out and moving to China. By accident, I sort of got into this startup in Beijing who needed an Android developer, and I had done a summer job as an Android developer, so I was the perfect fit, at least in my mind. Spent like a year and a half there, building the Android team and building the app. Came back, started freelancing, and after a year and a half, I joined forces with two of my freelance friends and started a consulting company called Devies. We ran that together for 4 years until I burned out and sold my shares to a Norwegian investor. Since then, I've been doing a lot of angel investing, but I'm also the CTO at a company called Baby Journey, which is a startup building an app for people expecting children and people with children up to 2 years.
That's awesome. And I have an awareness of your portfolio. So you've been quite active as an angel investor. There's a lot of people who says like, I'm an angel investor, and some does the media even write about them. And then when I compare, how many investments they've done and who they done it in, I compare it to someone like you, I'm like, oh, come on, it's like this is what a real angel investor looks like. You know a lot. So before we get into talking about like today's climate and all that, I want to just look a little bit like back, and if you review your previous investments, what's been the thread? What's been the principles that you've been operating on?
I would say that the first sort of batch of investments were I didn't really have a plan. Let's just put it like that. I found by accident again on LinkedIn people needing investments that were sort of in my circle. I knew they were good entrepreneurs, and I felt, hey, let's put some money here, see where it ends up. Second batch were sort of, then I had an actual idea of what I was looking for, like mobile space. I've been doing mobile for a decade, made sense, right? And third batch, that's where I'm in now, where I'm looking at mobile, but primarily mobile with some sort of B2B components to it. So I'm in Doktor.se, among others. Like they are, sure, they have an app, but the business is more than just like bringing users to an app, more than LTV CAC.
That's a great example, by the way. It's like, favor customer, and you're doing something cool in the space which is growing very fast with a lot of people coming into it.
Yeah, but I would say that like the common denominator through all of these, I've been in angel investing since 2019, almost 4 years now, and the common denominator is really the entrepreneur. Like that's my focus. I'm early stage, so usually the companies I invest in, they pivot once or twice, which means that when I look at a pitch deck, it's sort of, you can sort of get a feeling of where the company's going, but it usually isn't what it seems at the beginning, right? But if you don't have really strong entrepreneurs and founders, then you won't get anywhere. So that's sort of key for me.
Cool. So, if we take the same perspective and look a little bit forward, let's say we call this chapter 3. What are your principles now looking at companies today? So, just to give you a little bit more context, I think this will be very helpful for the ones listening who are, entrepreneurs, and they're starting a new company, and, what do they need to have for it to make sense to contact you?
Well, they have to have something in the markets, I would say. If they don't even have an MVP out in the App Store, I'm not interested. And that goes back to my point about the founders, because I need to see that the founder or founders are like enough of a hustler to actually produce something, actually get something out into the world, even though they don't have any money. Like that is absolutely number one. There has to be some traction. Like how you define traction is your next question. And that sort of varies a bit depending on what type of app it is. But you have to see, if you look at different parts of the app, different parts of the product, you have to be able to see that users who are active, they are spending a lot of time in feature X, Y, and Z, right? You have to see that you have something there that the user is actually interested in using. That doesn't mean that all of the app has to be great, even though that helps. But if you don't have at least one killer feature, you're sort of doomed to start with. And then, since I like apps who sort of have a B2B component, you have to have some clients or an idea of who your customer is, because the user is not your customer in this case.
That's good points. And you kind of gave me my follow-up question. I personally do a lot of investment in game startups, and one of the big challenges is that it's very, very hard to have metrics. And once you have metrics and they're good, it's typically too late.
Yeah, for sure.
So it's a tough industry to invest in. So which means that I need to go on other things, to try to triangulate, if I think this is something I should do or not. But how do you think? You were saying it yourself. What would be early stage metrics?
Yeah, so let's take an example here. I invested in a company called Shinner, which is a skating app, basically, where you use it to find spots that you can skate, like ramps or edges that you can slide on, and things like that, right? They, as far as I know, haven't done any like paid marketing yet. And when I invested in them like 1 or 2 years ago, they had spots in, I want to say like 1,000, 1,500 cities globally without really launching. So like there was something there, something tangible, and they had a couple of very clear ideas on how to be able to monetize and like gamify this whole experience too. So there's like something that proves that the users want what they're building. Like they have something out there, which means they've obviously launched. They're capable of building something, and there's an idea of a business. Which, like, if you're talking about mobile, an idea of a business isn't like always super common, but for me that's really important.
So, I'm starting to sense a bit of a framework here, for how you think around how a company is being built. Would you be willing to share just like how do you think about a company, from those like super early investment, super early success, to a company that gets into more with a growth stage where different kinds of investors than angels would be, totally jumping on this and wanting to get in?
Yeah, sure. So at the stage I'm investing in, like, the main reason why you need money is because you're not making enough of it yourself, right? And you're not making enough of it yourself because you're not really sure what the product you're gonna sell actually is. At least that's the case when you're building digital products. So you need sort of capital, and you need people who believe in you to get time to figure out where you can actually start making real revenue, right? Did that answer your question?
Well, you answered part of my question. I mean, to me, that sounds like a very early assessment, but I think you have a framework that stretches much farther. For what happens next? Okay, I'll give you some more. I'm gonna do like a bundle of questions. So like after that, what happens next? What is your role in next as an angel investor? And also what, I would love to hear what you think are the typical challenges, because, this stage that we're talking about now, I think could be broken down into like, micro stages on the way, right? And there's a couple of, we're going to gamify this. There's a couple of, milestones you have to, to win on the way.
Yeah. Well, I mean, are you talking about product market fit? Is that what you're asking for?
Yeah, I mean, that's part of it, right?
Yeah. So at the early stages, you're like a couple of people, a handful of people, 2 founders, say. You're trying to get something out there. You get something, you sort of prove that you can get it out there. And then you call me and I say, hey, this looks good. There's an idea of where we can take this. And I put in money. That capital means that you can sort of scale out and sort of outsource the stuff that the founder isn't world class at necessarily. Not completely, but you can sort of get a content person, you can get a marketer, maybe you can afford one more coder, right? I use that to sort of build out the idea that you have of how we're gonna make money on this, and start making some revenue. That's sort of where traction comes into play again. Now we're approaching the seed stage, where you say, hey, we have a model, we don't have enough customers, we need more money to sort of grow a bit further and keep fine-tuning, refining the model. Right. So then you raise a seed round, which means you have more capital, you can hire more people, you can offload the key people in the company so they can do even more of what they're actually best at in the company, maybe even best in the world at doing. And you can hire more coders, which means you can build more features, etc. But this is sort of where it gets tricky, and where I sometimes support my portfolio companies. Because when you go from, say, 10 to 25 people, people don't realize how big of a step that is. Like, you have to have completely new like policies in place, because like everybody don't know the founding story, and how come everybody does this way when we can do it this way. Well, you have to have a policy in place for that, right? If you're 25 people, you can't be one team anymore, so you need to split up into sub teams, which means you probably need 1 or 2 middle managers as well. And you as a founder, you go from being a manager of individual contributors and like pushing people really hard to deliver on time, to all of a sudden having managers reporting to you. And that's really hard if you haven't done it before. Like that sort of scale up phase. And then once you've used the seed money, hopefully you have, at least on paper, a clear path to where you could potentially choose to become profitable. Not everybody does that. Not everybody has a clear path, even though they say they do. But that's sort of where the Series A round comes in. And that's sort of where you go from being startup to more of a scale up. Yeah. But by then you should really have proven your product market fit.
You know, I really like the way you describe this. There's an amazing book called The Leadership Pipeline. And this book is designed for how to work with leadership succession in bigger companies. But, you know, it really applies to the life of an entrepreneur, and you know, making these kind of transitions that you are describing, where you go from being the manager of individual contributors to something different. It's not an easy one, and there's a lot of good entrepreneurs that are good entrepreneurs, but they actually can't make that transition. That creates an impediment for the company to grow. So I think, you know, thanks for describing this in such a straightforward way.
I would also like to add, like, it's really important to think about it from the start. I think like one of the hardest things as an entrepreneur is to like, well, on one hand you have to like, I'm a programmer, so I think in code, like I have this function with 2 lines that I need to refactor, like in the very details of what I'm building. I have to think about that, and I have to think about where are we going to be in 5 years? Like, have we gotten a sort of a good plan to get there? Like, do we have the right people in place who can grow and sort of take leadership roles, or do we need to hire somebody above them, which is also hard?
So I heard some investors talk about going from like going from you know, like a product market fit to like go-to-market fit.
Mm-hmm.
Have you heard that expression before?
I have not. What is that?
It resonates very well with what you're hinting at, which is the whole, you know, you reach that stage where the product is actually really liked by people. But in the B2B space, there are several VCs arguing that, you know, it's not like just because you have product market fit, you're suddenly going viral. You know, it's just not that simple. Now you need to reach go-to-market fit, which is that you need to really figure out, you know, how do you actually sell?
Right. Yeah.
Because it's not going to just explode overnight and suddenly, you know, your Stripe or Facebook. You know, it just doesn't work that way in the B2B space, at least. So, since you mentioned that, you know, You like the B2B space. I mean, what's your perspective on transitioning from something that some people like to something which is highly scalable?
I don't think I have a good answer for that, actually, because it's such a hard question. Like there's, if you're, I've mostly operated in the consumer space, so I'm not a B2B expert. But like there is this one word that sort of frightens me a lot, and that's procurement.
It frightens all of us.
Yeah, it's like this arduous process.
Frightens me too at Favor, which is my day-to-day job. You know, it's like procurement is a whole extra layer of work you have to do.
Yeah, and then it comes like I'm thinking about the book Mega Deals.
Uh-huh.
Have you read that?
Yeah, I have. Yeah.
Yeah, where they talk about having an insider, like Trojan horses, and it's like politics. It's super freaking hard, man. And that goes into like not only sales, like having excellent salespeople and training your sales staff and bringing a VP of sales at the correct time, but it also ties into like pricing strategy and like which features go where. Do we go open source? That's kind of popular right now. One of my favorite tools, cal.com, a booking tool, they're completely open source, which is why I use it, which means I introduce it wherever I go. Yeah. It's hard, man. I don't have a good answer.
Yeah, it is. But at the same time, you know, especially I think in hard times, having some success in the B2B space is attractive because it's also more sticky.
Yeah, for sure. Once you're in, you're in.
And I mean, you know, I can, if I speak from a favorite point of view, you know, when you have an organization who's doing better as an organization because of, well, partly because of, you know, that they're using Favro, they're not going to be, you know, wanting to go away from that anytime soon. So, you know, when you go through tough times, like now when, you know, tech companies are cutting down on staff and there's a lot of kind of negative signals in the market, there's also some strength in that. But I don't want to stay too long on that because I really want to use the time with you well, and I really want to pick your brain on how do you think as an angel investor about making an entirely fresh investment? Because now we just talked about, okay, well, what happens after that first investment? You know, how does the company grow? How does it scale? All of that. Okay, that's a very interesting topic in itself. But I really want to go back to the whole, well, when you're doing a fresh investment in this kind of climate, you know, is it just the same thinking as before? Is it different thinking? I mean, what goes through the head of an Indian investor right now?
Yeah, so like for me, it is the same, but the sort of perspective, the time perspective has shifted a bit. And if I'm to unpack that a bit, like one of my main issues as sort of a smaller angel investor, like I didn't make a $1 billion exit, you know, I don't have infinite money yet. So liquidity has always been on my mind, but now when the climate is as it is, like there's no IPO in sight. I'm not gonna get any. I'm not gonna see any returns from any investments in my portfolio the next 2 years, probably. I don't think so. Probably not in the next 3 years, which means I need to be extra mindful about how I allocate my cash. I need to stretch my liquidity over a longer period of time. Right? But I think that's kind of okay also, because one of the upsides of being an angel investor versus being a venture capitalist is that I don't have to make investments. If you're a VC and you raised a fund a year ago, like your LPs are gonna start like knocking on your door saying, "Hey, what's going on? Like, are you gonna start making investments again soon?" I don't have to do that. Like, I can just sit on my money forever. And most of the investments I've made last year has been into my existing portfolio, like support the companies that I already invested in, make sure they don't go under, right? But also I think like a recession is, I would say, least painful for investors like me who like early stage investments. Because like if I invest in a company today, like they probably wouldn't have been profitable in 3 years anyway, right? So when the market sort of turns up, they will be more mature and ready to sort of ride on that up wave. So that's sort of three things that I think about right now.
I think that's interesting. I mean, personally, I'm both doing direct angel investments super early, but I'm also, limited partner in 7 LP funds. So I also, also am one of those with that perspective. It's like, hey, come on, guys, make some good deals.
Yeah. But I will say one adjustment I made though. So I've been only doing like direct investments past 4 years. I am in the closing stages of my first SPV right now. So I will have made my 14th investment within the coming weeks, hopefully. And that is because that allows me to invest less money into this case, since I'm sort of ganging up with other investors. But I can still make small bets on the companies I believe in. And my philosophy as an angel investor is that I need to make a lot of bets, because the ones that go right, they go really, really right. So I just need to find them.
Yeah, I mean, that actually, makes me think about another question, which is that, when I'm looking at the strategy of the VC funds I'm involved with, they are typically quite transparent about how much they allocate to new investments versus how much they allocate to follow-up investments the investments that seems to be rising stars. And I would say that probably angels should have a somewhat similar thinking, because if you want to make a lot of money, you should have some capital allocated to be able to follow up on the ones that you actually think are following stars. Is that your thinking too, or?
Yeah, 100%. That goes back to liquidity as well. Like say I want to invest in 4 companies this year, like probably 2 of them will be good enough to make follow-on investments. I need to budget for that. Then again, I know there are angel investors like Dharmesh, co-founder and CTO of HubSpot. He's made hundreds of angel investments, and he doesn't do follow-ons. He doesn't even take founder meetings. Like, he does everything by email, and he doesn't speak to his portfolio companies. I can't do that because I don't have his deal flow. Well, like he invests in so many companies that it's okay. Like, if you run a VC fund, I think you're more concerned of building a concentrated portfolio. I haven't really thought about why though. Maybe it is because the fund has like a fixed life cycle. You sort of need to have a few really, really big winners, and then the easiest way to get big winners is to do follow-ons on those.
But what could an entrepreneur expect from you? I mean, I know you're a good coder. I mean, you can be CTO of basically any company. Could an entrepreneur who is getting, angel investment from you expect you to actually look at code?
Look at code, yes. Write code, no.
But that's great. That's a great answer. It's very, very clear. I think for everyone who's listening to this,
yeah,
I think that gives a very clear answer to, exactly where does the line go.
Yeah. I do help sometimes with recruitments. I helped one of my portfolio companies recruit a new CTO, for example. So that's also something I do for my portfolio companies.
Yeah, and that's probably very helpful because, recruitment agencies, yes, but, having a good network with people who knows people, that typically is the winning strategy.
Yeah, it's hard to recruit CTOs as well. Like we're a special breed.
Yeah, for sure. I think that's almost a segue to another podcast. We're going to talk about, how to recruit a CTO. Because to be honest, one of the big questions I get from a lot of the angel investments I've done is that they're actually missing a CTO, and they're asking me, how do we find a great CTO? And I think probably we should have a follow-up conversation on this podcast in a not too distant future where we talk about that, because maybe we could do like a conversation with you and maybe one or two also entrepreneurs who are in this process or just go through this process, because it's such a big thing, in these like super early stages of a company.
For sure. Yeah, that's it.
Yeah, I mean, that's a great idea. Well, anyways, Viktor, super thank. I mean, it's always a pleasure talking with you. I'm so happy that we could do it, publicly this time. I'm sure that our listeners got some good insights from your experiences, and I'm really looking forward to the next time.
Thank you so much. This was great fun.
All right, thank you.
Thank you.
And thank you everyone for listening. See you in the next one.
I hope you enjoyed this conversation. If you did, you know what to do. Share it in your social media so more people can take part and learn. And one more thing. Check out Favro Academy on favro.com for many more learnings. Thanks for tuning in.